Welcome to PIMCO Pod. In this episode, we discuss why the direct lending sector is under scrutiny and highlight how the broader private credit universe, spanning asset-based finance, consumer and mortgage credit, and specialty finance, continues to offer diversified and attractive investment opportunities. Stay tuned after the conclusion of the podcast for additional important information. Private Credit's Other Lanes Still Offer Value by Lotfi Karoui and Gabriel Casabil. Concerns about private credit have intensified in recent months. Investors are grappling with questions about weakening credit quality, stale valuations, looser underwriting, redemption risk in certain types of funds, and the impact of AI-driven disruption. Much of the anxiety has centered on corporate direct lending, especially business development companies, BDCs, and semi-liquid vehicles. This narrow focus, however, can miss the bigger picture. Private credit is a broader and more diversified asset class, offering a range of differentiated risk exposures. Beyond traditional corporate senior secured lending, private credit spans asset-based finance, ABF, and specialty finance, real estate, and special situations, each with distinct drivers of risk and return. Taken together, these distinctions point to a more nuanced set of investment implications, which can be grouped into a few key themes. That broader private credit universe still earns its place in portfolios. ABF and high-quality consumer and mortgage credit has continued to offer meaningful diversification and more attractive value than direct lending. ABF is generally less correlated with the corporate earnings cycle and benefits from structural downside protection. Selective exposure to consumer and mortgage credit, particularly related to higher-income households, can offer a more attractive risk-reward profile. Direct lending will ultimately meet the credit cycle. Like every mature segment of leveraged finance, direct lending should eventually face a full-blown default cycle, one that would test its resilience to both sector-specific and macroeconomic shocks. Early loan vintages, originated soon after the global financial crisis, benefited from stronger documentation and lender control. In the ensuing years, record fundraising has steadily eroded underwriting standards. As overlap with public markets has grown, direct lending funds have increasingly offered terms comparable to those in public leveraged finance, without providing any meaningful compensation for illiquidity. Persistent opacity and weak disclosure around issuer fundamentals are therefore likely to keep concerns about credit quality and portfolio price marks firmly in focus. While AI disruption risk and portfolio concentration will likely continue to cap performance, heavy exposure to the software industry in direct lending portfolios is likely to constrain relative performance versus both public markets and other segments of private credit. At the same time, the rise in portfolio overlap across managers has compressed performance dispersion, limiting the scope for manager selection outperformance, alpha, a dynamic increasingly evident in the relative performance of recent vintages. Mind the liquidity gap. Across private markets, semi-liquid vehicles have expanded rapidly in recent years. While the risk of a bank-run style event escalating into a systemic shock remains low, given the structural safeguards embedded in these vehicles, recent episodes are likely to prompt investors to reassess both the amount of illiquidity they are accepting and the compensation they receive for it. They also underscore the importance of understanding how liquidity is accessed across different types of semi-liquid structures. Direct lending fundamentals, opaque by design, signaling caution by proxy. By design, direct lending portfolios and private assets more broadly are not publicly disclosed, which makes it harder to assess their underlying fundamentals. In the absence of transparency, market participants have relied on proxies. BDCs have emerged as a particularly useful reference point, given that they report quarterly and provide relatively detailed information on their holdings. The share of payment in kind, PIK loans in which borrowers pay interest with additional debt has been rising since 2022. Meanwhile, recent price action in public BDCs suggests investors are demanding higher compensation to guard against a variety of risks, including potential stale price marks and deteriorating fundamentals. BDCs now trade at the largest discount to their book value since the post-COVID recovery began. The share of PIK loans in BDCs' portfolios rose since 2025 near post-COVID highs. BDCs are trading close to their largest discount to book value since the post-COVID recovery started. Larger deals, software-heavy, and alpha-light. Total assets under management, AUM, in North American direct lending portfolios has increased roughly sevenfold over the past decade, from $93 billion in 2015 to about $644 billion by year-end 2025, according to Prekin. Any asset class that experiences such rapid growth is prone to developing imbalances, and direct lending is no exception. As capital inflows surged, demand for loans increasingly outpaced supply, fueling greater borrower and sponsor friendliness, and thus a gradual weakening of underwriting standards. At the same time, the sheer volume of capital committed to direct lending has supported larger transactions since 2023, deals that would historically have been financed in the broadly syndicated loan market. This shift has increased overlap in the borrower base, a dynamic often loosely described as convergence. What was once a market almost entirely dedicated to middle-market borrowers has thus taken on quasi-syndicated characteristics, with large deals often underwritten by a group of lenders. This evolution has mechanically increased portfolio overlap across managers. Here again, BDC portfolio data corroborate this dynamic. The share of traditional single-borrower, single-lender transactions, long the hallmark of middle-market lending, has declined in recent years, while larger loans involving multiple lenders have become increasingly prevalent. The share of traditional single-borrower, single-lender transactions in BDC portfolios has declined. The composition of BDC portfolios has been gravitating toward larger capital structures. In parallel, two other shifts have also taken place. First, portfolio overlap across managers has been on a steady rise. Portfolio overlap has materially increased in recent years. For each pair of BDCs, we sum up the minimum weights of overlapping issuers in both portfolios. We then calculate the average across all pairs. Second, the heavy involvement of private equity sponsors and software companies, combined with their reliance on direct lending as a preferred financing channel, has driven pronounced sector concentration, with the share of software more than doubling in a decade. The share of software companies in BDC portfolios is elevated. For investors, the combined impact of these forces is weaker diversification and higher cross-portfolio correlation across managers. Semi-liquid structures. No systemic threat in U.S., but a wake-up call on selectivity. In addition to non-traded BDCs and private real estate investment trusts, REITs, the semi-liquid universe expanded rapidly from 2019 to 2023 to include evergreen and interval funds. This growth has been driven by the uptick in investors' appetite to deploy capital into private markets in real time rather than to be constrained by discrete vintage cycles, though the bulk of private assets continue to be largely invested in vintage funds. Semi-liquid vehicles have experienced material growth in recent years. Non-traded BDCs and private REITs are not included. The bulk of private market assets remain invested in vintage funds. Total AUM in semi-liquid vehicles, including non-traded BDCs and private real estate investment trusts, REITs, versus vintage funds. We only include funds with at least $100 million of AUM. While the risk of a true bank-run dynamic in these vehicles is generally low, given explicit contractual limits on redemptions and the ability of managers to gate flows, semi-liquid does not mean fully liquid. As with traditional vintage funds, investors must still assess their own liquidity needs and tolerance for constrained access to capital, particularly during periods of elevated volatility. The recent scrutiny on redemptions in semi-liquid direct lending funds has brought this distinction into focus, underscoring that liquidity is conditional rather than guaranteed. What is often less appreciated, however, are the meaningful differences within the semi-liquid universe itself. While these vehicles offer investors the option to deploy capital on a rolling basis, they operate under different regulatory regimes and differ when it comes to giving investors access to liquidity. For non-traded BDCs, private REITs, and evergreen funds, access to liquidity ultimately sits at the manager's discretion. In effect, investors are short a put option to the manager. The value of this put option rises precisely in states of the world when aggregate liquidity demand increases or market conditions deteriorate. In those moments, the gap between stated redemption terms and realizable liquidity can widen materially. By contrast, interval funds eliminate this optionality. Repurchases occur at predetermined intervals and are capped at a fixed percentage of the stated net asset value, NAV, providing investors with certainty of execution on the terms offered. To be clear, interval funds are not more liquid. Rather, they are less ambiguous and more transparent. Liquidity is explicitly limited, rule-based, and applied systematically rather than discretionarily. Private credit's other lanes still offer value. Private credit extends well beyond direct lending and continues to merit a place in well-diversified portfolios. As the cycle matures, the relative appeal of ABF as a diversifier is likely to continue to increase, precisely because returns are driven more by collateral and structural protections than by pure earnings growth. The opportunity set spans a wide range of exposures across the economy, including residential and commercial real estate, consumer credit, and specialty finance. And unlike direct lending, which is predominantly non-investment grade corporate credit, ABF may provide investment grade-like risk profiles that are less capital intensive for large allocators such as insurance companies. The result is a large and still underappreciated opportunity where diversification and downside resilience, rather than headline yield alone, underpin the investment case. Recent PIMCO research using public securitized products as rough beta proxies for ABF, an approach that abstracts from both liquidity premia and manager selection alpha, suggests that potential ABF risk-adjusted returns are not only more attractive than direct lending, but also exhibit greater resilience to market downturns and lower sensitivity to fluctuations in risk sentiment, as proxied by equity returns. Thank you for listening. That was Private Credit's Other Lanes Still Offer Value. For future insights, please follow us on your favorite podcast platform. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.